I'm Charlotte McLeod with investingnews.com, and here today with me is Nick Hodge, editor at Daily Profit Cycle. Thank you so much for joining me. Great to see you.
Charlotte, always good to be with you.
Really good to be speaking, and we're going to begin where we usually begin at these conferences, which is I ask you about your talks that you've given. So this time, they didn't post the names of the talks online, or at least I didn't see them. So tell me what the names are. Usually they're pretty fun, and what you've been speaking about here.
So the main stage talk was a cycle through commodity land and a parked headline warning. And then in the breakout session with my partner Gerardo, we did an episode of our podcast, which you normally do here, we recorded, but the title was What Hasn't Worked, What's Working, and What Will Work. All
right. And what sort of topics did you cover there? What are some of the highlights?
In the breakout session?
Yeah, let's go for that one. Yeah.
Yeah. So what hasn't worked was base metals have been really tough, despite people saying, the long-term fundamentals for copper are very robust, and we're going to get a copper super cycle. We've seen that copper move down from $4 to closer to $3.50. And if you look at base metals index, it's sitting at 52-week lows, for example. And so base metals is one thing that hasn't worked yet, and we attributed that to sort of like the slowdown in the economy and the expectation for a recession coming. And then one other thing that hasn't worked is gold stocks relative to the gold price, because the gold price has been okay, especially despite a strong dollar and high interest rates. But it's up something like 18% for the year, I think, at last check is what it was. And gold stocks aren't up that much if you look at the GDX. So they're supposed to be showing leverage to the gold price as we expect. They're supposed to be going up by multiples are certainly higher than the gold price is going up in percentage terms, and we haven't seen that yet. And I also think that's a function of a higher interest rate environment where people can get yield elsewhere, so they're not necessarily interested in a 3 or 4% yield from like a Newmont or a Barrick, and I think also still being cautious in the stock market in general. So while gold has worked, the gold stocks haven't worked.
Okay, and to be clear, when you talk about base metals and gold stocks, they haven't worked. It's kind of a they haven't worked yet situation. So these are coming up. You would see it turning.
That's right. So we can skip over what's working and let's talk about what will work. Gold stocks was one of the things that will work. I think we'll see a return to people wanting to buy gold equities as the price breaks out above 2,000, and so I expect that to happen. It's unfortunate that the catalyst that perhaps sparked the rebound from the low 1800s in early October. But despite the geopolitical and turmoil and wars in the Middle East and Ukraine, et cetera, there's a very strong underlying fundamental reasons to own gold, not the least of which is the fast rising debt and deficits in the U.S., but also on the very real prospect that after 2 years, the Fed is going to have to pivot in 2024. And I don't know if you recall talks that we've had over the past 12 or 18 months, but I was saying there's not going to be a pivot. Jerome is very serious about getting to 2% inflation. And so lots of people wanted a pivot sooner than we've gotten it. And I think once it finally does come in 2024, then you're going to see a very robust gold bull market, and the equities will finally follow.
Right. And I think I looked back on the interview that we did here last year, and we kind of said, gold wouldn't really shine until after a recession and the pivot from the Fed. And, we just got the Fed's latest meeting. They left rates unchanged. So maybe we talk about that a little bit. Have we reached the top at this point?
It's an interesting question. So let me define it in rate of change terms. So pausing is not easy. Pausing is higher rates for longer. And so even if it is the peak, the rates at the levels they're at now are having very real effects on bank balance sheets and other things, et cetera. I also think that, again, Jerome Powell is very serious about the 2% target. He mentioned it, I think, 6 times yesterday or this week when he gave his speech. And so he very much wants a recession. I mean, he very much wants the inflation to come down to 2%, and it's nearly at 4%. Do we get another hike is an interesting question. I think it depends on the labor market. So that's typically the last thing that goes in an economic cycle, and employment is rear looking. And so I think when the employment starts to go in 2024, it's gonna force him to cut. I didn't answer your question. I don't know if it's the top. I think he might have to squeak out one more because I see the economy reinflating. The rate of change inflation coming down sort of stopped, right? We were all the way up, near 9% last June, and it came down to the 3% range, but has stopped going down, and in fact has ticked back up above expectations for the past couple of months. So as this economy reinflates, I think he hikes another time.
Yeah, and I think you started to say this, if next year we start to go back down on the rate hikes, it doesn't mean we go back down all the way, right? That's an incremental thing as well that we have to live with. So maybe we can talk about what kind of situation we're heading into there, because I hear from a lot of people, this process is going to break something, et cetera, et cetera. What are your thoughts?
Things have broken. I mean, you had bank collapses in March that were bigger than bank collapses in 2008. And so things have already broken. The consumer is starting to break. They're at record high credit card debt, at record high interest on that debt. They're starting to fall behind, being more delinquent on those credit card debts. And so things are already breaking. As far as what's going to happen for the next couple of quarters, I think we get back to recession talk, which has sort of been alleviated. So the U.S. GDP just printed 4.9% for the third quarter. That's a pretty robust growth. I mean, the economy was growing in the third quarter. You can argue about what that growth is attributed to, which was largely government spending and not the consumer. But let's set that aside for a second. As we get through Q4 and we get to Q1, that growth is going to come back down to 1 to 2%. And so you're going to see a slowdown. What I was saying in my main stage talk is that I'm using this opportunity for the next 2 to 3 quarters because I've been reserved with a third cash to really identify what I believe are going to be trophies, high quality companies that I want to add to my portfolio ahead of what I see as a pretty booming and strong resource market post-recession, which I still expect to come.
Yeah, and that was one of the things I wanted to check in with you about, because you have said, I think in at least our last 2 interviews, that cash position that you have. So did you say that's about a third of your, okay. And so can you talk a little bit about where you'll be looking to deploy that?
Yeah, so I defined trophies. I was saying I was hunting for trophies, and I was defining trophies as companies that don't have to raise money, companies that are in tier 1 jurisdictions, companies that have top tier management. And so as far as commodities, which may be what you were asking, copper is one. I think we're going to get a good copper bull market post-recession. Gold is another one. I'm looking at companies that are cashed up and developing assets that they've already financed. They don't need to raise additional money for. So we have a known resource in the ground and then likely a feasibility study. So we know the economics. And then uranium, I suppose, would be the last one, which has been in a bull market and continues to be. So wouldn't be opposed to allocating some more capital there.
Yeah, I think it's good to bring up uranium because it feels like this is one we've been talking about probably for years at this point. So interesting. So you still see opportunities there, which makes sense. But where do you think we are in the cycle right now?
Oh, everybody does baseball parlance. So, no, it's interesting. So uranium has had a good run. I mean, we had a good run in 2022, and then it sort of got ahead of itself and blew off a little bit. And the retail crowd got frustrated. If you track sentiment on, message boards and Twitter and things like that, people were throwing in the towel. They were frustrated with uranium because, like you say, we were talking about it for so long, and they thought that run that we had in 2022 was it, right? But what happened is it ended up just being a healthy pullback, and the price of uranium has gone back up. And now it's breaking out. It's north of $70 a pound. It's through resistance, which was at the $73 or $74 a pound area. And yet the utilities still haven't come back into the market. So it's done this on the back of things like trusts buying pounds, producers refusing to produce and instead buying pounds. And so you still have catalysts ahead for the utilities to come back into the market for that uranium price to go higher. So back to baseball parlance, it's World Series time. So, third-ish, 4-ish inning.
Okay. And, you're mentioning, so we need those utilities to come back into the market. We've had that excess supply taken up and we're waiting for them to come in. So I guess what a lot of people are wondering right now is what happens with the price, right? Are we going to, where it's going up, I think we can agree on that, but how?
Yeah, so uranium always overshoots to the upside. It's like silver in that respect. I'll tell you in terms of my partner, that way I don't have to go on the record with my crystal ball. My partner Gerardo is calling for $200 a pound. That's not a sustainable price, right? That's the fervor gets going, it overshoots to that price, and then corrects to something more healthy in the low $100 range, $100 to $120 a pound. There was a report recently, and you have to excuse me because I forget the group that it came out from, but they were calling for an overshoot to $300 a pound. Not some marketing group. This was a serious market research institution, and so the calls are out there for triple digit uranium quite high. When does it get there is an interesting question. I think when the utilities come back into the market and realize that there is a scant supply to be had, and then word gets out in those circles that they really need to start securing their supply.
And, I know it's hard to know what utilities are doing or thinking at any given moment, but do we have indications that this is happening already?
I mean, you see them starting to come back a little bit. There's been companies like Encore Energy that has already sold some uranium, has penned some contracts. Other companies, the UECs of the world are unhedged, right? They don't want to lock in prices now with the utilities because they want to wait for the price to rise. So the short answer is no, we haven't seen the utilities come back in the market the way we've expected and the way that they're going to have to.
Yeah, okay, and you bring up an interesting point there, companies waiting because they want to get the best price. So, what would you want or expect to see among companies that have supply that they need to allocate?
I'm not sure I understand the question.
Yeah, I think let me try to rephrase it better. I think, would you want, if you're invested in a company, do you want to see them doing deals right now? Do you want to see them wait? What makes the most sense right now?
So I'll talk in terms of Encore, of which I'm a shareholder, so full disclosure, and have been for a while. And it's sort of a two-pronged approach, right? They're bringing a new facility into production that they haven't assigned all the production to. They haven't gotten rid of it. And they're also storing physical pounds. So it's a multi-pronged approach. And that's likely the best approach for me, as opposed to an entirely unhedged strategy, I would say, because you're getting, a hybrid, best of both worlds, or whatever phrase you want to use.
Yeah, no, that does make a lot of sense. Okay, so maybe we can talk a little bit more about how investors may want to strategize when it comes to uranium, because, some people probably have already made some gains at this point, but there's room to go, right? So where do you see the best value right now, I guess it's the question.
I'm going to give you a long answer, and I'm going to start with an example. So the reason that I am an Encore shareholder is because they bought a company I was invested in called Azarga Uranium. And the reason I was in Azarga was because I was invested in a private company called URZ that Azarga bought. And so this is going back some 6 or 7 years now. And I had a gentleman ask me a question in the workshop here, how do you think about selling? When do you know if it's time to sell? And I told him I've been selling along the way. Not entirely, but when Azarga took out URZ, I sold a little bit. And when Encore took out Azarga, I sold a little bit. But yet I remain an Encore shareholder. And so I've profited. 2, I've reduced my cost basis because I paid myself to own the shares. And 3, I can diversify then into other positions. So I'll tell you one thing I've done is taken some of those profits and reinvested them in less risky positions. So whereas in the early part of the cycle, back to baseball, and the first or second inning, I was had larger positions in more speculative companies. As I've taken some of those profits off the table, I've moved them into less risky propositions like URNM, like in the ETFs, for example. So I'm more diversified, and I get a little access to physical because the ETFs in some cases own shares of trust that own physical pounds. So I think that answers your questions as far as where I see the value, because that's how I'm sort of rotating capital in the space.
Yeah, that was actually very specific. So thank you for that. So I think this will be my last uranium question. We'll see. But, we've talked, as I said, we've been talking about uranium for years, not just with you, but with others. And, everybody kind of had their one thing that they were waiting for it to take off. And now it seems like that's less the case. It's just kind of factors all together coming to push the price up. So what are you watching on the supply and demand? Is there anything specific?
I mean, I think a couple of things. The advent of small modular reactors is going to be big because it's going to add to the entrenched demand that we have from the established nuclear fleet in the world. The processing and the bottleneck from Russia is also very interesting. So you ask where there's value. I mean, there's value in processing, specifically in the Western world, which doesn't want to be getting their uranium from Russia at this point. So maybe taking a look at a couple of processing companies might be a smart thing to do.
Do you know any examples of those? Because I asked somebody that question right when the whole Russia situation started happening, and I don't think I got a very good answer to that from whoever asked.
Yeah, there's a couple of companies. There's Converdyne, which actually just reopened a conversion plant in the U.S. There's a company with the ticker LEU, which stands for light and enriched uranium, and so there is a couple of publicly traded equities that you can look to get involved in the processing space. Cameco, to some extent, is diversifying, vertically integrating. They acquired Westinghouse and such, and so to get broader exposure without owning an ETF, Cameco might be one place to look as well.
Okay. I think that's helpful because I think people would be interested in that angle for sure. Okay, so any other elements of the resource sector that you're watching right now with interest?
I always watch things with interest. Hydrogen is interesting. Where they're going to store it and how are they going to make it. I'm of the belief that one real good solution to decarbonizing is making hydrogen with nuclear reactors, because it doesn't make a lot of sense to do them with renewables. But you have to store that hydrogen somewhere, and so that's an interesting resource angle because there's a couple of companies that are exploring for caverns that are able to store hydrogen underground. And actually, we're here in Louisiana, right? We're in New Orleans, and the Strategic Petroleum Reserve of the U.S. is stored around here in the Gulf area, and it too is stored in underground caverns. And not a lot of people know that. They think it's stored in tanks, but it's natural formed underground formations. Same in the American West, like New Mexico and Arizona, we store gases underground there, like helium, in naturally formed domes and caverns underground. And so there's been some exciting companies that are looking for underground salt domes, particularly. These are because salt is impenetrable by gases underground, that are exploring for salt domes to store hydrogen. So that's something novel that I don't see a lot of people talking about.
Yeah, I know that I need to do some research on hydrogen. I always get stuck on the different colors, and that's where I get...
Oh, sure. Essentially green and gray. You either produce it with fossil fuels, or you produce it and that's gray hydrogen, or you produce it with renewables and that's green hydrogen.
Okay, not as tricky as I thought, so I should get on that. Okay, just wrapping up here, I'm asking this question to all or most of the people I talked to today. So do's and don'ts for investors as we head toward the end of the year into 2024.
Don't confuse gold stocks for gold. They are not the same thing. We just covered that earlier in the talk. Do take your tax losses if you're able to harvest them. We're heading here into the end of the year. There's a lot of debased and undervalued equities, as all these CEOs will tell you. But get rid of your companies that aren't performing. Don't be afraid to sell losses. Now is the time to concentrate on winners, and you only have to focus on the best in breed companies. And so make sure you know what's in your portfolio, know what you own, and harvest your tax losses.
Okay, I think that's a nice place to wrap up. So thanks for going through all of the different commodities that we spoke about. This is a good overview, hopefully, of what you're thinking right now.
It was a great chat. I appreciate it.
Perfect. And once again, I'm Charlotte McLeod with investingnews.com, and this is Nick Hodge. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.